Welcome to this Killick Explains Finance video. This week, part 2 of my How to Deal with Foreign Currency Risk series, and this time turning my attention to funds, because a lot of UK investors may not want to invest directly in overseas assets, but they might pick funds that do that for them. Should you pick a fund that's hedged, or should you just pick a plain old unhedged fund? Let's have a look. So the problem is a familiar problem. Lots of people want to invest overseas. They're quite happy to leave that to a fund manager, but they are going to take on potentially foreign currency risk. In other words, even though someone else is doing the investing for you, they on your behalf are running both investment risk, that's the idea that what they buy might go down as well as up, and foreign currency risk, the idea the exchange rate could move while you're invested. So why would that matter? Imagine a UK fund manager's got some US investments. All right, so £1,000, very small example, is invested when the exchange rate is £1 to $1.50 and buys the fund manager $1,500 worth of US investments. So far, so what? Well, hopefully the fund manager knows what they're doing, so that investment that was $1,500 becomes $2,000. Great, $500 profit. And when that's translated back into sterling a bit later, at the same exchange rate, there's an assumption I've just made, it turns into 1,333. So you might be thinking, well, great, you got it right then, because started off with £1,000, now got £333 off a $500 profit. What's to worry about? Well, the point is, you've probably spotted it, that is not a realistic assumption, that the exchange rate just hasn't moved. Because if the exchange rate were to move, so that it's no longer £1 to $1.50, but moves to, let's say, $2 to a pound, in other words, the dollar's weakened, or the pound strengthened, as they say, then the $2,000 turns into £1,000 of sterling, and suddenly that's no profit at all. So that's a potential problem if the exchange rate moves against you. Now, of course, you could say, aha, but it could go in your favour. Yes, it could, but you don't know. I mean, it could be the case that the $2,000, that's the original $1,500 plus the $500 gain in local currency, comes back over to the UK when the rate's 1 to 1. In other words, the dollar's strengthened and the pound's weakened because it buys fewer dollars. And that means $2,000 becomes £2,000. Fantastic. Sterling profit on the original £1,000, £1,000. Well, you doubled your money. But the fund's taking quite a risk here because these outcomes are pretty far apart. Everything from making nothing on the original money that you've got with the fund to making a little bit, £333, to doubling your money. Well, that's a pretty big difference. So as an investor, you kind of want to know what the fund's up to. And the reality is that fund managers can choose, and they have to tell you in the marketing literature, to hedge or not hedge foreign currencies, and it does make a difference. Now, how do they decide? Well, the bottom line is, if they want to hedge out the foreign exchange rate risk, in other words, remove it, they'll pay for that. They use contracts called derivatives. I'm not going to go into the details here, but they pay a price to do that. So they're always thinking, is it worth paying that price or not? And as an investor, you've got to think about that too. Do you want a fund that's hedging foreign exchange risk on your behalf or not? You will pay a price if they choose to run hedged positions, but you might benefit. So how do you make up your mind which one to buy? Well, I'll give you a few pointers, some rules of thumb. With bond funds, it often makes a lot of sense, not always, but often makes a lot of sense to buy a fund that is doing foreign currency hedging, because bond funds are kind of steady as you go type funds, all right, they're not spectacular growth, and foreign currency can wipe out any gains they make in a given period. With equity funds, I've got to be honest, the case is more debatable. You want to take some advice on this because it does depend. With an equity fund, you're hopefully going to get a fund that can beat any foreign currency movements in performance terms over a given period. All right, so therefore it's a more marginal case. Do you want to pay the extra cost of the hedge? I'll give you a couple of illustrations. Let's take a couple of currencies. The US dollar, safe haven currency, the currency that people tend to run to in times of trouble. So, you get quite a bit of dollar strength. And if you're a UK investor, invested in a fund that's got US dollar assets, maybe you want to benefit from that dollar strength. And if the fund is hedging the dollar, you won't get that benefit. I'm not saying therefore never buy a hedged US dollar fund, but you've got to think about it. Japanese yen, we've seen over the last 5 years, tends to strengthen, not always obviously, but tends to strengthen as Japanese equities weaken, or vice versa. So if you buy a hedged fund, notice my expression, hedged fund, basically you could be doubling up your downside, and that's a bit of a problem. So it's another example of a currency where you don't just want to jump in and say, yeah, let's take out the foreign exchange stuff. That might not work in your favour. And here's another example of where you might think funds would hedge foreign exchange rate risk, but actually they often don't. Emerging markets, incredibly volatile. Markets can go all over the place. The currency can go all over the place. So surely fund managers would normally hedge an investment in emerging markets. Actually, they often don't, and you need to know that as an investor. And the reason, without going too technical, is something called carry cost. In order to set up the hedge between, let's say, sterling and the Brazilian real, if interest rates here are 1% and there are 10%, and that kind of is a differential you will see between developed and emerging markets, the fund's going to bear a carry cost, as it's called, of the difference of 9%. Now, even if you don't know what I'm saying there, what I'm saying is the cost of running a hedged position is sizable. So the fund manager might decide not to bother, even though the fund's invested in a very volatile market. And that's going to mean, as an investor, the fund may not be hedged. So make sure you've read the small print before you buy the thing, and it will be pretty volatile, guaranteed. But that's because the fund manager has taken a decision not to hedge currency on the basis of the cost involved of doing so. All right. And then one final thing. People sometimes think, oh, crikey, I want to change my mind. You know, I didn't buy a fund that was hedged. Now I wish I had. Now I want to be in a hedged fund. Or I've got one that is hedging foreign currency and I wish they didn't. Is it worth switching? All depends. Where you've got one fund with two different share classes, you can do it fairly cheaply and fairly quickly, and you don't incur a capital gains tax bill normally on doing so. All right. In other words, the fund's got a class of share that's hedged, another class that isn't, should be a straightforward switch. Your problem's going to come where you're looking at switching between either two different types of fund at the same fund house, or even two completely different fund houses. All right. And there, A, the costs of doing the switch will probably be more anyway, and B, you might trigger a capital gains tax disposal on the one you're kind of closing down and selling. So, got to think about it. Again, worth taking a bit of advice, not just sort of jumping in, as it were. So there it is. Considerations as a UK investor in funds that invest overseas. Quite a bit of ground covered. Questions to the usual place, please.